topic that we're going to discuss today on Your Money Matters is going to be about Mirae Asset NYSE FANG Plus ETF. Now, this is an interesting one because if you go ahead and invest in this ETF, it is going to give you exposure to global markets. And to discuss about this particular ETF and as to how you should strategize your investment and maybe use this ETF to probably enter into global markets or maybe diversify your portfolio, we are joined by Rishabh Desai, who is the founder of Rupee with Rishabh Investment Services, joining us now. Rishabh, hi, always a pleasure speaking with you. My first question to you is, let's give viewer a perspective as to what this ETF is exactly. What are the kind of companies that will fall under this, and how much of a global exposure will an investor sitting in India get through this?
Hi, Mahima. First of all, thanks so much for having me on the show. As you correctly pointed out that this particular product, invests in the overseas market, predominantly the US market. Now, this is a passive product which gives investors international exposure in the US market. This is number one. Number two, this product mostly invests in the technology and internet companies. Number three, this product is a very concentrated product in which consists of only 10 companies with equal allocation. So this product is not going to be a well diversified like a flexi cap fund or a multi-cap fund, which consists of probably say 30, 40, 50 stocks or so. This product is going to be very concentrated and only limited to 10 companies itself. Now, the beauty of this product is, since it's a passive product, it has a back-tested, fantastic track record and has managed to deliver superior returns over the longer period of time. Now, coming to the constituents of the underlying portfolio. Now, this particular product invests in giant technology and internet companies like Netflix, Alphabet, Amazon, Meta, Microsoft, Nvidia, Apple, so on and so forth. So this particular product is going to invest in not only like international companies which is based in US, but these companies have massive global presence in different continents and different countries throughout the world.
Okay. Rishabh, you were talking about the percentage of exposure in different companies. That is as of what date?
This is as of 29th of August, okay. 2025.
29th of August, 2025. Okay. Okay. Rishabh, in terms of, this particular fund, it mainly focuses on IT companies, right? So the concentration is very high when it comes to your exposure in IT companies that are situated in the US. Considering that and keeping that in mind, do you think that more than, let's say, 5% of your portfolio should be allocated to something like this fund?
Mahima, first of all, let's understand that which kind of investors would be suitable for this product. Right. Now, in my humble opinion, see, aggressive investors, long-term investors who are looking to take some kind of global exposure, who understands the global market, I think that is the kind of investors one should be looking at to invest in this kind of product. Now, someone who does not have that much of patience or that much of understanding of the international markets, because see, one needs to also understand, say, if you buy this product at the wrong time at the wrong price, then of course it's not going to be fruitful for you in terms of returns. So I feel if one is investing in this product needs to be really timed well, so that investor can get the returns what they are wanting. Investors can get the double-digit superior risk-adjusted returns. Okay, so I think investors looking to take global exposure, one can look at this product, because this product is investing in only 10 technology and internet companies, and which has proven to be fantastic in terms of delivering returns over the period of 3, 5, and 10 years.
Okay, all right. With regards to just want to understand that if somebody is going ahead and buying this ETF, first of all, let's help them understand as to how they can go ahead and buy this. It should be, of course, as easy as just going on a brokerage platform and buying it. But considering that, should this be a one-time investment that you make in this ETF, or would you suggest an SIP? What should be the course of action?
Mahima, first of all, see, unfortunately, this particular product is not taking fresh investments. See, when you go and buy an ETF, you can always buy the ETF on the secondary market, which is traded on the National Stock Exchange. Okay. But in terms of going and buying it from the mutual fund house directly, it's not allowing fresh investments because RBI has capped or restricted investments going abroad, and unfortunately the limit is completely exhausted in most of the funds, most of the overseas and international funds in the mutual fund space. Now if someone wants to buy this product, then the only way to buy the ETF is to go to the stock exchange online and buy it. Now the reason why I'm not recommending investors to buy this product right now, there are two specific reasons why. See, one is that this ETF is trading at a very high premium to its INAV. Okay, it's trading actually 20% premium to its current value, what it actually should be. Okay, and number two, the valuations of all of these companies, all of these 10 companies are trading very high. So if you actually go to see from a returns point of view, as on 29th of August 2025, see, 1 year returns of this particular product has been around 67%. 2 year returns has been 58% CAGR. 1 year is absolute. 2 year is CAGR, which is 58%, and 3 year returns, again, CAGR returns is 53%. So 53% CAGR is mind-boggling, Mahima. So number one is that the ETF is trading at 20% premium, and number two, the valuations of the underlying companies are also trading at very high premium. So these are the two specific reasons why I feel that investors should not go out and venture in this product, at least at this point of time.
Yeah, and okay, so apart from this, then, if one wants to have an exposure to the global markets, what should be the course of action for that particular investor?
See, at least at this point of time, just stay patient, just stay put, right? When the valuations turn reasonable, and when the premiums come down, I think that is the right time to get into it. See, if one is doing an SIP, that's different. There are very few AMCs who would be still be taking SIPs. But in terms of lump sum investment, I am definitely not encouraging investors to invest lump sum money in the US market. So just stay put. When you see a good dip, when you see a good dip in this product, when you see valuations correcting, premiums coming down, that is the right time to venture in this product in the US market. And again, coming to your the point that how much should investors take exposure in the global markets or in the US markets, I think anywhere between 10 to 25% of allocation you in one's core portfolio should be very healthy.
Okay, and overall, considering that this is a global fund, any difference in terms of tax implication, if you're aware?
No, the taxation would be as similar as what it is in India. Long-term and short-term capital gain tax remains the same. There is no special taxation for international funds.
And in terms of, we talked about this as to how this is concentrated in one particular sector only. Given a chance, would you go ahead and invest in something like a Mirae set right now, or maybe play the IT theme and go for something that has more concentration in Indian IT firms, considering the Fed rate also coming in? Fed rate cut is expected this week.
Okay, so I usually don't recommend investors to venture into sectorial funds, especially in India. I think if someone wants to take IT bets in India, then going via flexi cap funds, multi cap funds, focus funds, or any other mutual funds via mid caps, small caps, I think that is the wise thing to do, and let the fund manager do its job of how much exposure he or she wants to take into IT at this point of time. But because these are giant companies, especially the FANG Plus portfolio is a very mouth-watering portfolio, and the earnings have also been phenomenal. The returns, there is no doubt, has been phenomenal, but the earnings have also been phenomenal of these companies. So I feel I'm very comfortable taking this kind of thematic bet, because it goes out of the geography, out of the Indian geography, and is venturing in the US markets. See, I tell this to all of my clients that some global exposure is very important. See, when we talk about diversification, it has to be from a holistic point of view. So it has to be from a fund level, it has to be at a category level, diversification has to be at an asset allocation level, diversification has to be from an AMC level, style level, and at the same time diversification also needs to be from a geographical level as well. So I think US has been very consistent in delivering returns, and the returns what I just spoke about, I mean, like 1 year returns has been 67 and the 3 year CAGR returns has been 53% CAGR. So I mean, the track record is definitely proven. These are giant companies having global presence in different continents and different countries. So I am definitely comfortable venturing in this product, but at the right price and at the right time.
Okay, Rishabh, thank you so much for giving us those insights. And of course, always, thank you so much for taking out the time and speaking with us at NDTV Profit.
Thank you so much, Mahima.
All right, the other piece, that you as a retail investor should keep in mind is how buybacks are being taxed, especially because Infosys came out with a buyback of 18,000 crores at a 19% premium. It is very important to understand that if you are holding Infosys in your portfolio and if you are participating in the buyback, what will be the tax implications on you? Harsh joins us with more details on that. Harsh?
The taxability of this is going to hold critical fort if you are an Infosys shareholder and going to opt for buyback. So you really do want to listen to this one. Let's talk about what the law says. Buyback proceeds are taxed as dividend income, not as capital gains. And dividend income, so basically the full 1,800 rupees will be taxed as dividend income in your hands. That's the first piece of the law. Company will deduct a 10% of the buyback value as tax deducted at source, and no other tax will be paid by the company. So company is completely exempt. They'll pay out the 1,800, but out of that 180 will be deducted as TDS, and thereafter 1620 will be paid out to the shareholder. 180 as TDS will reflect in your account. The tax paid by shareholder at income tax slab rate. So your dividend income which is coming in at 1,800 will be taxed at a slab rate. It could be 0, it could be 10, it could be 20, 30, whatever your slab rate is. That's the key component that you need to find out before you opt for this buyback offer. Capital loss, though, of course, because you've had a purchase price built into the shares that you've opted to give out for buyback, the capital loss can only be set off against other capital gains and not dividend. So you actually have to have gains to ensure that that loss gets offset. That's something you want to understand. Let's break it down into easier numbers. 1,800 is your offer price for buyback. TDS deducted will be 180, which will reflect in your account, which is the shareholder's account. The net payout will be 1,620 rupees in your account. Now let's talk a little bit about what the tax could be. If it's a 20%, it's 360 rupees on the 1820, and 30%, it's 540 on the 1820. That brings the gains to lesser, or rather the accrued number of profit will likely be lower for some persons. If at all you sell it even at market, that could be slightly more sensible as well for some. So you want to take note of that part. Cost of shares to be treated as capital loss, I did mention that, so that's all. And capital loss can be set off, can reduce tax only if you have other capital gains. I want to reiterate that. Last off, most relevant pieces. Shareholder falling in the higher slab rates are disincentivized from opting for this buyback. You still want to do the math with your chartered accountant, but and therefore will be subjected to higher taxation on the full 1,800 rupees upfront. But again, if you have capital gains, that may vary, and cost is to be treated as capital loss and set off against capital gains. That will remain common even for shareholders in a lower income tax slab rate, but they are incentivized because you will have a far lower rate which could be payable on your total cumulative amount coming in of 1,800 rupees, but you will also get a deduction likely if you have capital gains. So there is of course an incentivization for some of the lower income tax slab rates shareholders, but a disincentivization for some of the higher slab rate shareholders.
All right, Harsh, thank you so much for sharing with us this interesting piece as to how buybacks are in fact taxed. Very helpful to a retail investor for sure. But with that, we're completely out of time on this edition of Your Money Matters. But do stay tuned for more news and updates on the other side.